There it is. Okay, so we know that we have the property in Florida. And this is important purely just for the state. So there's four different parties that want to enter into a joint agreement, right? And this joint agreement is just that you're buying the property. And so we know that party A is probably going to pay more of a percentage than the other three parties. So for this, we're going to divvy it up like this. And so what we did here was we just calculated the interest in the company or how much ownership you have. And this is important just going ahead. And then you guys wanted to build an actual formation around it, and this is your LLC. And we know from the 704B rules, although we have this ownership interest right here, we can choose what our profit and loss looks like. Now, the important part of this is that there needs to be economic effect, and it has to be substantial. And the point of this is essentially to say that party A can't pass all its losses on to party B if they're incurred. So yeah, party A cannot pass all the losses to party B if losses are incurred, if B can't pay for those losses or gains. And you see this a lot with a nonprofit. So if a nonprofit were to go into partnership with a for-profit company, the for-profit can't pass the gains or the taxation of the gains to the second party because the nonprofit obviously isn't taxed, right? So this is what this is talking about. So in this conversation, that won't affect you guys because everybody can essentially pay for those gains or those losses. So that's where the 704 comes. So again, we went here, we started here with our interest using the 704B rules. The actual profit and loss split is probably going to look something like this. Again, the four parties, but each party is going to pay for 25%. And again, these are the same business, but again, this is ownership versus profit and loss and the pass-through entity. Now, how this is going to look is every single person here, so up here in the actual partnership, you'll do what's called a 1065 partnership return. And then each person will get a K1, right? And this is the partnership share of it, right? And then that K1 will be used on the 1040. So then the question becomes, how is each individual taxed? Now we know that real estate, because again, we talked about on the phone, roughly 98% of all real estate, residential real estate, is going to incur a loss. And that's specifically because of depreciation. Now, how does it flow on to your guys' actual returns? So this is how I split up all my clients' financial asset classification. So over here you have your assets, so your holdings, your stocks, your investments, things of that nature. And here you have your actual operations. And then everything flows down into your trust. So the K1, again, is holding an asset because it's a house, so it's going to flow onto your asset side, right? Because it's a form of passive income. So the first question that you guys asked was, is the income received from the asset passive or active? Now, to answer the question, all this income from this rental property is going to be considered passive. But real estate is very, very particular in the IRS treatment of the passive income from real estate. So there's essentially 3 buckets that you can have. Now, passive, this is the last bucket that we want to be in. We never, ever like to be in this bucket, but you may. Active, and then real estate professional. Now, unless anybody's going to put 750 hours into this, generally for you guys and what we talked about, you guys won't quite be in here. But again, if you guys will, we can talk through that. Now, if you were in the passive bucket, for example, and you're in the passive bucket, if you're less than a 10% owner stake and you don't do anything in the property. So generally you're here if you have a syndication, if you're investing in REITs, if you're investing in someone else's flips, etc., etc., etc. That's what puts you in this bucket. Now, if you were in this bucket, again, we don't like to be, but if you were, this passive income offsets all other passive income, right? So again, if you had, for example, a negative $10,000 if you made $10,000 in the stocks market, then that negative $10,000 loss in real estate would offset that, and that looks like a zero gain. But if you make $100K in your job, this is considered active income. So then, although you have this $10,000 loss, you cannot use this loss to offset the active, right? So this is how all passive income works. Now, the IRS has what's called literally just a special allocation. That's awkward. I spelled allocation wrong. A special allocation for real estate treatment, right? And this is in publication 925. It's like page, I want to say 9 or 10, but I don't quite know. But it's in publication 925. So what this says is that if you are an active participant in your real estate, then you have a $25,000 allowance that you can write off, or sorry, not write off, you can offset active income. And this is, again, based off of what you guys are saying on how you guys will treat, how you guys will work in the job, you guys will all be in the active bucket. So when I say that, although it's a passive passive loss, because of this special allocation from the IRS, you can use this passive loss to offset any active income. So this is all W-2 income or biz income. If you make less than $100,000. And then if you make more than 100, but less than 150K, there's a phase out limit. So if you made $130,000, you would subtract 100K from it, get this number, and then this number divided by 2, so it's going to equal $15,000, and then you're going to do 25K minus the 15K. And then, so instead of the the $25,000 allowance, you now get $10,000 to $10,000 of passive losses to offset active income. Now, that's going to answer your second question. So again, just so we cover the questions in full, is this income passive or is it active? All real estate income will always be considered passive income when you're talking about real estate investing, right? So obviously there's wholesaling, there's developing, there's general contracting, there's a ton of other things that you can do in real estate, but no, specifically for real estate investing, it's always passive income. Now, if you are active participant, right? So if you're working in the business, and really the distinction here is, are you making decisions? Right? That's really what it's about. There's more things, and we can get into more specifics, but are you deciding what your property manager is doing? Are you deciding the things that are going to get fixed? Are you deciding what property you're going to buy? Are you going to decide if it's going to be sold? Are you going to be making the decisions, right? And so that's the real distinguisher, is if you're an active participant versus a passive participant. And you can see with like syndication, REITs, like if you were to give me money and I were to develop a property for you and then give you the money on the sale, you didn't do anything in that process. I did it all, so you're a passive investor. In this specific example, you guys will be active active participants in the business activity. So what that allows you to do is take that passive loss that you guys will probably have, and then use that passive loss to offset active. Now let's go over the one last scenario that may affect you guys. Let's say you guys make over 150K, right? So any one person makes over $150,000. So that means that you guys don't get any, you can't use the passive losses to offset the gain. Now, in this example, what happens here, and we talked about this, it's called a suspended loss. And I forget what actual form it is, but just know that when it's a suspended loss, it goes into a new bucket, right? And all those losses go into the bucket. And you save these. And then when you have another passive income that is greater than any passive losses you have, you can use these saved suspended losses to offset the rest of that passive gain. And the important thing is, although you'll accumulate the suspended losses with the property in Florida, you can use this to offset any passive income. So whether that's selling of stock, whether that's you selling the house, anything of that example. So again, it's very important that even if we make over that $150,000 threshold, we constantly save those suspended losses and we track those, because those can offset future passive income. So again, if you guys have any more questions, please let me know. Obviously, if this wasn't clear, let me know and I will fix it. Or I can go into more detail, whether you have questions here or there. Other than that, you guys have a great day. Talk to you guys soon.